Hello everyone, I'm Mark Sain and welcome to Sain Investment Solutions. Please take a moment to pause this video and review the following disclaimer. Thank you for that. Welcome to week 7 of the Forex market review. Today we're going to take a look at a couple pairs which we traded this week and what's coming up for the remaining part of the week and what happened in the US overnight. Let's jump straight to those charts. So last week we mentioned that we had the Euro USD pair and we're looking at trading that one south. So that was coming up prior to the Fed announcement which occurred overnight. So this one here we're looking at for the pullback up to this resistance area, the DSR zone which we have, and also this 200 EMA line. We then would have dropped down to the 1 hour, 4 hour chart looking for some AO divergence. Now that's for the less aggressive trade, or we don't worry about the 4 hour AO divergence for the aggressive trade. In this case, we had the 4 hour AO divergence with our higher price and our lower AO. So that tells us that we can go for a lot more and maybe not be as aggressive, so we don't have to worry about getting out of the market. You can still take both trades, the aggressive and the non-aggressive trade, when even with the 4 hour confirms, just means that the aggressive one is likely to possibly make the money quicker because you don't have to go as far, but it also could stop out because you really need the price to stagnate, pull back, and then really go in your direction. So you need time on your side, and that's why the non-aggressive trade works well, allowing you more time with a higher stop loss. But once we have the 4 hour divergence, we would then look for a 1 hour. We want to see a push down, pull back up, and then we want to see the first large AO. So down the bottom here, the first large AO is this one here, which is wave 3. So if we just scroll back to roughly how that would have looked back then, once we see it come back and cross the 0 line, we will then grab our Fibonacci retracement tool, go from the high to the low, or pretty much the front of this wave. If you're not quite sure, come to the front of it. So roughly around this point here is the start. And here it's very clear, 1, 2, 3, and it doesn't end until it comes back above the 0 line. So that's the low point. You need to pull back to a minimum 38.2, which it has. And we try to look for a bounce lower off this 1 hour 200 EMA line. So what happens is it came up, gave our confirmation, pushed back lower. You would have entered in the market somewhere around here. Now, if you were doing an aggressive trade, very tight stop losses, probably had about 30 pips. More conservative, probably have something a bit like 50 pips. And pushing back lower, it's come down. Here you got your 1 for 2 around there for your aggressive trade, and you definitely would have brought you back to break even, and it never hit the break even part before reaching your 100 pips, which is a double the 50, and there's your 1 for 2 there. How far do we think we think it might go? Again, before you even get in the market, what you want to do is grab your Fibonacci expansion tool, and then you go from the start of 3 to the bottom and then back up to wave 4 pullback. And we want to look at getting out at the first Fibonacci expansion level or the 100%. So both of those have now been triggered, and therefore you definitely would be out, and you would have made at least a 1 for 2 risk to reward on this Euro USD trade, which was announced last week. Early this week, we had a USO USD, which is the oil trade. So we've seen some resistance around this level here. Drop down to the 4 hour chart. We want to see a lower low in price and a higher AO. So here we don't have the lower low in price with a higher AO. So we can't take the conservative trades. It's going to be a really aggressive quick trade. Drop down to the 1 hour chart. We look for the first large AO. Again, the end of it is the end of the wave 3, and the beginning of it is roughly the start of wave 3. So looking at probably 1, down for 2, up for 3. See our minimum pullback of 38.2, which it did. It came and crossed through the 1 hour 200 EMA line. Because we don't have the 4 hour AO divergence, we want to drop down to the 1 hour chart and see if we can find maybe even 15-minute AO divergence. Here we don't have the 15-minute AO divergence. It's just going to be a bounce off this 200 EMA line. Shot up, enter the market, tight stop losses, probably about 35 to 40 pips. It's gone up to 60, 70 pips. So if you had the tight 35 pips, you definitely got your 1 for 2. If not, you definitely would have brought it to break even. Exited some of the position at 1 to 1, and then the remaining position has been stopped out. So in this case, the very tight 35 pip stop loss would have delivered you 1 for 2. And if not, you definitely got 1 for 1. Half your profits have been taken off if that's part of your trading plan, and then the rest would have got at break even in this move higher. Still a successful trade because we haven't lost any money. Euro New Zealand has also occurred. So what we can see, it's pushed down, it's broken through this resistance level. We then look for any AO divergence. So we got no lower low, lower AO, so there's no 4 hour AO divergence, so this is going to be an aggressive trade only. Jump down to the 1 hour chart, look for the large AO, that's wave 3. Follow it back to the beginning and then up to the top. So here's 1, pullback for 2, push higher for 3. So we need wave 4 to pull back to the minimum 38.2, which it did. It's also come and tested the 1 hour 200 EMA line because there's no 4 hour AO divergence. Let's see if we have a 15-minute AO divergence. And we do. We see it stepping lower with AO divergence. So here's your higher AO. And here's your price dropping down. So definitely we do have AO divergence on this leg here. So what we then want to do is look for that push back through, enter the position. Probably you got a stop loss again of around 35, 40 pips. Here you've reached 75. So again, a very similar trade to the oil. Here, if you had the tight stop loss, you've definitely made your 1 for 2 and you're out the market. Worst case scenario, if you have slightly larger stop loss, you would have taken probably 50% off at 1 to 1, risk to reward, and the rest you would have got at break even. So this one's a successful trade as well. If you had a really tight tight stop loss, but you really wanted to push back high and you got up to these levels up here, then you're probably looking at 50 pip stop loss. So you might have not brought it to break even, and you might have still been in the market. So at this stage, it hasn't hit the stop loss, which would have been down here. So you could still be in the trade. All depends on where your entry signals are and where your exit signals are. And the only way you can determine these is to backtest, backtest, backtest. You need to backtest so you can find out the probability of using a 10 pip stop loss, a 5 pip stop loss, getting in on an aggressive bullish candle. If it breaks some type of moving average line, maybe you've got a 5-day moving average line which you've put on here and you want it to break. Very simple, just go to your tools, so charts, insert an indicator, trend line, moving average, maybe 5-day moving average, simple close, we'll keep the same color, there it is there. So you would have said, okay, yep, that one, this candle right there has closed above this 5-day moving average line. So that's what I'm going to use to get into the market. Maybe I'm going to use that to get out of the market. It all depends on your trading plan, but don't just throw something in and then wing it. You have to back test it to see the probability of it working. And if it works well over at least a year's history, then you can start pushing it forward on very low volume and seeing how it moves going forward. And therefore you have probability on the side, and you can afford to ride out some of the losers, because sometimes you might get 3 in a row. Some upcoming trades we have: 4-hour chart, higher high in price, lower AO. So we're looking at a more conservative trade. It's come down, it's tested this 4-hour 200 EMA line. So really we got 1 up for 2, down for 3. Did it pull back to the minimum 38.2? In this case it didn't. So therefore, if you're doing it based on wave counts, that's 3 up for 4, down for 5, you would cancel this trade. However, because this is a very conservative trade with our 4-hour divergence, you can look for a pullback based on the 4-hour chart. So we want to see this AO come back up to the 0 line, and then hopefully you see a zigzag up to these levels here. I'd be looking at this DSR zone for my resistance areas, and if they can pull back up into there, then I would be looking at selling it as well, coming up to this 1-hour 200 EMA line. And therefore you probably got a 50-60 pip stop loss. Definitely bring it to break even before the lows. How far do you think it will go? Again, Fibonacci expansion tool. This time you'd probably best to grab it from the extreme highs to extreme lows. If it pulled back to those positions there, you definitely could look at 1 for 2 down to the first Fibonacci expansion exit zone. Zoom out, look for some support, and definitely at the 100% level you'd want to be getting out, because that also matches up with a daily DSR zone. Another one is the USD yen. As you can see, there's quite a few USD yen pairs. This is all part of the announcement which happened overnight with US Fed Chair Janet Yellen being a bit more hawkish, or in this case bullish, in regards to interest rate rises. And she announced that it would be unwise to hold off on increasing the interest rates. So therefore it's very likely she will want to increase them at least 3 times this year, and she doesn't want to hold off for too long. So that's going to be positive for the market. So any decent pullback would be a good entry signal. In this case we have 4-hour AO divergence. So therefore we're going to look for a buying opportunity this time on the USD yen. So in both pairs, the New Zealand USD and the USD yen, the yen strength is what we're looking for. So here has wave 1, down for 2, up for 3. Just missed entry there. So if you didn't get into the market and you're doing wave counts, it's probably you can cancel this trade. However, because for me it's the conservative entry, I'll have a lot lower stop losses. I would look for a pullback down to this area down here, and hopefully a 4-hour AO come back a bit. If it pushes too much higher up to these zones up here, then I'd probably personally be looking at cancelling the trade as well. Thank you for that. That was week 7 of the Forex market review. Here at Sane Investment Solutions, we wish you all the best in your success. Take care. Bye-bye.